9.1, I gave you the overview. 9.2 was the valuation. Now we got 3 easy sections. These are called, this one is relationships. So what are some of the basic relationships? They tell us we got 4 major relationships. Alright, well, what's the first relationship? Yield to maturity. Number 1 is actually very easy. When yield to maturity rises, this means that the discount rate is rising, and it means that the price of the bond falls. We say, because this is up and this is down, we say that there is an inverse relationship between yields and prices. When yields rise, prices fall. Well, recently we did a calculation where just right after Donald Trump was elected, on the same day, bond yields went up like so many, 20, 30 basis points, and 20, 30 basis points resulted easily in $100 billion loss in the bond market. Alright, so that's the first basic relationship. As you increase the discount factor, which is the yield to maturity, the price gets lower. That's easy. So that's, again, page 296. Number 2, let's see what it is. The market value of a bond will be, if the required due to maturity, is the coupon rate. Alright, so coupon rate and yield to maturity. If the bond is yielding, let's say, 10%, is yielding 10%, which is less than the CR is the coupon rate, okay, then it follows that price will be, it's yielding higher. So the price will be less than 100, same as 100%. If the price is less than 100%, the yield is higher. Whoa, wait a minute. Why right here less? Yield to maturity is less. If the yield to maturity is higher, the price is less. Sorry, guys. The opposite is true. If the price is less than 100, the yield will be higher. So, this relationship goes both ways. If the yield is higher, the price will be less. We call this at a discount. So it will become a discount bond. And the opposite is also true. If yield to maturity is less than the coupon, it will be a premium bond. It's getting hot, right? We need air conditioning, right? Come on, guys, one of you push the button. So, when a bond sells at a discount, we call it a discount bond. When a bond sells at a premium, we call it a premium bond. That's on page 297. All right. Number 3. Let's take a look and see. All right, guys, excitement is over. Now we get to the boring stuff of bond relationship. What's number 3? So, as time approaches maturity, as maturity gets lower, in other words, we get closer and closer to maturity, the price approaches par. 100% is par. This will require a little bit of a picture. Say this is par, okay, 100. Let's say this is 90, and this is maturity here. And there are maybe 5 years to maturity. So, the price will zigzag, but as it zigzags up and down, it will eventually, as we get closer to maturity, will converge to the face value. That's simple. If it's a premium bond and sells at a premium today, it may be zigzagging every which way, but eventually it's going to be moving closer and closer to the par. That's relationship number 3. And now, number 4. C. What's 4? Long-term bonds have higher interest rate risk. Okay. So, as maturity rises, in other words, as the bond gets longer and longer term, the price volatility gets higher and higher. Well, how do we say price volatility? Well, volatility is sigma, that's the variation in price. So, sigma of the price, if you like sigma of price. If you can like, you can say sigma of the bond, or bond price will increase. Okay, so sigma increases. In other words, risk rises with maturity. Next, when interest rates rise, the price falls. Falling price due to rising interest rate is called interest rate risk. So, interest rate risk is the risk of bond price falling because interest rate increases. This interest rate increase is the same as yield to maturity. So, here, instead of yield to maturity, I can also say interest rate rising is the same as bond price falling. These two are the same thing. So, interest rate risk is the risk that bond prices will fall. when interest rates rise. What this relationship is saying is that long-term bond prices fall more than short-term prices than short-term bonds when interest rates rise. So, when interest rates rise 1%, 10-year bonds will fall a lot, and 5-year bonds will fall a lot less, and 5 months bond will fall almost nothing. In other words, short-term bonds are not sensitive, not interest rate sensitive, and long-term bonds are very interest rate sensitive. So, interest rate risk is the same as interest rate sensitivity. Sensitivity means change, how much the price changes when interest rates go by 1%. And interest rate risk is the same as interest rate volatility. So, volatility measures risk. Well, that's what 2 chapters ago. Alright, let's see if I got something else. Alright. Line 3. That completes number 3. So you need to remember 4 basic relationships. Number 4 is types of bonds. Well, they give us like 7, 9, 4 types. I already covered. All right. Secure. Is there a collateral or no collateral? If there is, we call it secured. If there's no, call it unsecured. Number 2 is priority. If it's a lower priority, we call it subordinated. Subordinated means it gets paid after all other bonds are paid. Now, after all other unsecured bonds. Well, otherwise it's called unsubordinated. Unsubordinated means it gets paid before subordinated, but unsubordinated gets paid after the secured. Alright, so these unsubordinated and subordinated relate to unsecured. Okay? That's it.
So what are secure and pay
So, first gets paid secured. Second gets paid unsubordinated. Last gets paid subordinated. But the subordinated still gets paid before stockholders. This is all debt. Okay. And then we said, we will say next week that preferred stockholders will get paid before ordinary. So this is the priority. And do you remember who gets paid first? The government. Government taxes get paid first, before everything else. All right? Let's see what else. Number 3. Initial offering market. It simply means where was the bond sold for the first time. And for example, there is a special type. It's commonly used. You'll hear it a lot on TV and read in newspaper. Is called Eurobonds. Eurobonds. Okay, these are bonds sold in a foreign country. The next key characteristic is risk. It may be low, it may be high. If it's low risk, they're called junk bonds, which are the same as high yield bonds. Okay? And these are called high grade bonds. Repeating, high grade means low risk, junk bonds mean high risk. So, risk. Low, risk, high. Coupon. What about the coupon? They may have a very low coupon or they may have no coupon. In other words, bonds with no coupon are called zero coupon bonds. These are bonds that pay no coupon. They pay only face value on. So these zero coupon bonds will be sold, we call it now, at deep discount. Deep discount. So they're sold at a deep discount, okay? Meaning significantly below par value. Now, some bonds may be paid early in the sense that if it's a 10-year bond, they may pay 10% in the first year, 10% in the second year, 10% in the third year, 10% in the fourth year. All right, so they'll be paying them over time. If it's paid over time, it becomes amortizing. amortizing bond. You could keep paying it over time. And the other one is, how they call it, non-amortizing. So, amortizing bond is similar to an amortizing loan. You pay it off over time, okay? So, when you get closer to maturity, you need to pay less. In non-amortizing bond, you pay only interest and no principal. So, in amortizing, as you're paying off, you're paying partially some principal. Maybe 10% of bondholders will get their principal this year. Maybe 10% of bondholders will get it next year. Is it fun? And number 7. A bond may be convertible, as in convertible to stock, or non-convertible. Convertible versus non-convertible. And it's not in this section in the textbook, but I did it before. Number 8. Callable. Callable. It may be called. In other words, the lender may prepay early. All right, let's go back to section number 1. That's page 286. Page 286. So, definition becomes a callable bond is a bond with a call provision. With a call provision. All right, that's section 4. All right, and now we got section number 5. Determinants of interest rates. So, guys, I have to, you move away from somewhere else. Yeah, just move some other desk, some other place. You keep talking to this guy all the time. I hear your voice. Just move away, or up, or back, or front, anywhere else. Okay, number 5, last section, so that you can go eat lunch, right? Is determinants of interest rates. What determines interest rates? And I got a whole bunch of factors which we're going to do. Number 1, inflation. Usually, the higher the inflation, the higher the nominal interest rate. That's very simple. So, if you expect inflation to go from 2 to 4%, all investors will demand a higher interest rate. So, we will have nominal rate, interest IR, just stands for interest rate. I, R, short for interest rate, okay? ER means exchange rate. So, nominal interest rate is interest rate which includes inflation. This is what you get in terms of money. And the other is real. Interest rate after the effect of inflation, after subtracting inflation. So this is before inflation, meaning inflation is included. This is after inflation, meaning if inflation is excluded. And we got what is known as the Fisher effect. What's the Fisher effect? Is as inflation or as inflation expectations rise, nominal interest rate will increase to incorporate real interest rate. So, interest rate nominal equals to interest rate real plus inflation. If inflation rises, usually inflation expectation rises, nominal interest rate will rise or increase to reflect the increased inflationary expectations. That's the Fisher effect. And this becomes, respectively, the Fisher equation. This is the simplified version of a Fisher equation. For small, real, and nominal rates, it's usually good and correct. Well, how they spell it? Without C. Yes, they spell it without C. Fisher, spelled without C. All right. And interest rates have an inflation component, and there is a risk component. The risk component, or we call it compensation for risk, is called risk premium. Premium means compensation for risk. So, what are the risk premium? All right, number one. Default risk will become default premium. Okay? Number two. Some bonds will be more liquid, other bonds will be less liquid. Liquid is ability to sell the bond quickly and close to its fair value. So, some bonds are very hard to sell, and if you sell it, you gotta sell it at a lower price. This is called liquidity risk. And you will have liquidity premium. What other risks do we have? Oh, okay. Maturity. Becomes maturity premium. Now, let's clarify that longer maturity means longer interest rate risk. So, the maturity premium is an extra, is a compensation for interest rate risk. Okay? What else? Liquidity, maturity, default. And this particular piece here, this particular inflation piece, becomes inflation risk, becomes inflation premium. Premium is same as return, extra return. So, extra risk, extra return. Well, we'll write it out. Any risk will mean extra. Premium. This is the second fundamental pillar of finance, that all risk is compensated with return. It's the fundamental principle that higher risk means higher return. So every risk component, all right, let me write this out here. We'll call these risk components. Risk components. So, bonds will have a default component, liquidity, maturity, inflation. They may have some other political whatever that might be. Okay, so real risk-free versus real, that's here, page 306. Page 306. Inflation premium. So, when we say interest rate, we can write plus inflation, or we can say plus inflation premium, which is simply a premium for expected inflation. All right, I got this part, inflation premium. Now,
for the Fisher effect, the equation is something like this. It's not, we have to
plus a little bit the cross product. Forget about, for now, the cross product. It's not as important. The cross product, you will read, let me see where it says, is usually ignored when interest rates are small, becomes 1/1000 of a percent, to the point where it's insignificant. Cross product is important when inflation is 10, 15, 20%, when interest rates are 10, 15, 20%. If interest rates, okay, for you, if interest rates are 2% and inflation is 1%, then the cross product is 0.02 multiplied by 0.01, which is equal to 0.00301, I think. Oh, 2, correct. This is equivalent to 0.02%, which is like next to nothing. In other words, it can be safely ignored when either interest rates or inflation rates are small. Okay? So that's nothing to worry about. Now, let me see where I was. Back to my stuff. Okay. Now, default risk it becomes default premium. I already covered this before. It's got a different name. The default premium is equally called credit spread. Which is compensation for a default risk. So this and this is the same. So the default premium and credit spread are the same thing, okay? Don't get confused. So I got this part. Maturity risk premium. That's page 307. Page 307. Okay. The maturity risk premium 307. Next, liquidity risk premium 307. Inflation premium, did I write it here? Inflation risk, inflation premium, again, 307. And now we get to the next thing called the yield curve. 9.4, we are now at 9.5. All right. Yield curve is a chart, a graph that shows you yields to maturity and maturity. And it's a nice, simple, easy picture that businessmen should know and understand. It's common sense. Here you got maturity, and here you got yield to maturity. And usually, but not always, yield curve is rising. Meaning yield to maturities increase with maturity itself. This yield curve we call normal. It happens most of the time. But yield to maturity could be falling. You pay more to borrow short term than long term. This is very rare and happens only when the economy is weak and when the bond market expects recession. So, weak economy and recession. Recession expectations, or the economy is already in recession. This falling is called, it's got a special name, it's called inverted. Inverted yield curve. Alright. This rising normal, that's figure 3. Page 308. All right. This one here is figure 5 on page 310. So, default risk plus liquidity, all right. Now, why would the rising be normal? Two things. Here, it's falling because in a recession there is a expectation for falling interest rates. So let me do this a little bit again. That's the real component. As inflation is expected, the economy is strong, there will be inflation premium. This is that you expect somewhat higher inflation over time. And there may be an extra that will be maturity premium. Okay. And here there may be other premium. So, the yield curve, let's just notice, is usually for the same default risk. Okay, for the same default risk. The only difference is in maturity. You only want to separate the maturity. But you got to incorporate longer time, longer maturity. We'll have an extra compensation for inflation, extra compensation for maturity, and possibly extra compensation for liquidity. So usually borrowing longer term, that's why I said usually normal is interest rates are higher. All right, let's see what else I got. Now, there's also one other little piece. Not simply higher maturity means that there's got to be compensation for maturity. If it's a higher maturity, it simply means that there is additional default risk. Default risk rises with time. If the company is in good financial condition and has to pay back within a year, chances are it will. Within 3 or 5 years, the financial condition can deteriorate. So default risk increases with maturity. 30 years from now, for a bond, 100 things could happen. It could be a war, political disaster, economic disaster. 100 bad things can happen that can increase default risk. Okay? So default risk usually rises with maturity, and therefore default risk may be also incorporated as rising over time. That's on page 308. The longer the maturity, 308, the last paragraph, the more likely it's that the firm issuing debt will have some problems and may default. And the other thing to understand is that the yield curve can shift. It can rise, the short term can rise more, the long term can rise more. Okay, let's just do this piece because you're hungry, right? This is the yield curve, very low yield rates. They went like this. As soon as Donald Trump got elected, within a couple of hours, the yield curve shifted little on the short end, but jumped a lot. So, it jumped an awful lot. 30 basis points in one day is like a bond market crash. And here it may be only 20 basis points. And in the short end, maybe only 2 or 3 basis points. So the yield curve, we say, when it moves, we say the yield curve shifts. Okay. Let's see if I have something else. Because I think, yes, I am done. And so are you.